So this is one of the big, what do you say, problems which people face when they're doing value investing, is how to avoid value traps. You know, a company with good prospects for growth might be undervalued for some reason because of temporary, setbacks, or because of market conditions and all that. But the business model remains robust and can continue to grow for a long period of time. You know, that would what I would call a good company which is undervalued. But there may be companies which don't have a outlook for big growth in the future, and because of that, not many people are interested in owning the stock, and because of which you'd find that they're quite cheap. Sometimes the management quality is poor enough, that's why it is cheap. I would say going back to say the mid 90s, for instance, when IT industry in India was taking off, a company like Infosys uh, was, in a sense, premium priced in the market. So it always traded at a higher P than all the other companies. But there are a lot of other companies like Pentafor and Silverline and DSQ Software and those kind of companies, which also were benefiting from the boom in IT exports in India and were making good money. They were trading at relatively cheaper valuations. But if you looked at their results over a 2 3 year period of time, they were growing at the same rate. They were generating the same kind of ROE, and they looked to have the same kind of prospects. But they did not have the quality of management that Infosys had to be able to change with the times, find new markets, find new clients, and all that. So when the Y2K boom died out in 2000, many of these companies which are benefiting from the Y2K boom did not have any business going forward, and they lost clients, they lost business, and all that. And many of them no longer exist. So they were cheap stocks, but they were not undervalued. You know, but Infosys was undervalued in 1995, for instance, when the company made a conscious decision to give up GE business, because GE used to contribute almost 20% of their overall revenue, and GE was using their position as the prime customer to squeeze all the companies to lower the rates for themselves. I think management of Infosys took a very bold decision of giving up that business so that they could not compromise on margins, and they were very confident of finding other clients to replace GE. And for a period of time, Infosys growth actually stalled, for 2 or 3 quarters, and the stock became cheap as a result of that, because many people were not sure whether this was a good strategy. They were not sure whether, but Infosys came back to the growth path. The stock became so. I would say that was a classic example of a good quality company which was undervalued because of some reasons. Many of the other companies which are trading at lower Ps were not undervalued, but they were cheap for a reason.